Now let's learn how to calculate the dividend yield ratio. Now first we need to understand that shareholders, when they buy a company's share, they're expecting return in two forms. The first form of return that every shareholder expects is in the form of dividends. That's the cash payment that the company will pay a shareholder from the earnings it has made. The other form of return that a shareholder would expect to make from buying a share is called capital gain. Now, what is capital gain? Capital gain is essentially the difference between P1 and P naught. Now, what's P1? What's P naught? P naught is the price at which the shareholder bought the share. We can also say the investment. And P1 is when the shareholder sells this share in the market. At what price does he sell? So, if he sells it at a higher price, the difference between them becomes the capital gain. So if I just plug in some numbers, let's say a shareholder buys a share for $10, I can call that to be P naught, and he sells it, let's say 1 year later, for $20. So in this case, $10 becomes the capital gain because the $10 share was sold for $20, so that's a profit of $10 over here. That's the second form of return a shareholder can expect. Okay, now what is this ratio doing? The dividend yield ratio is essentially measuring the real rate of return for an ordinary share. So the dividend yield is only calculating the cash return on investment. So it will only compare the cash return that a shareholder made on the investment made by the shareholder. And the investment, by the way, will be P naught at which it bought the share. So what we are looking at is we're trying to calculate this. The dividend per share, that's the dividend that has been decided to be paid off to the shareholder upon the market price per share, or P naught. Market price is the investment, because if you guys think of it like this, when a shareholder goes to buy the share in the market price will be the investment that the shareholder makes. And dividend is the cash return that receives during the year. So multiplied by 100 will give us the real rate of return earned on an ordinary share, or the cash return on investment. Right? So let's apply this to a very simple example. So let's say a company has paid a dividend per share of $2 and the market price per share was $20. Right? So any shareholder who bought this share for $20 has now received a dividend of $2 per share during this year. And this $2 includes the dividend paid and proposed. Now using this, can we calculate the dividend yield? So 2 upon 20 essentially gives you a 10% dividend yield. Now what does this 10% means? It means that if anyone makes a $1 investment in this company's share, if it buys the share of this company, they can expect a 10% cash return on investment. So it becomes a very useful metric to compare other cash returns available from, let's say, other government securities or any other bond available that is paying you return over there as well. So dividend yield is very often used by investors who are trying to compare how much cash return can they expect on their investment, and they can compare it to other stocks as well while making their investment decision.